I think that's not really the right way to look at it. It shouldn't be concerning if you're sitting on silver and markets close. I can't think of another asset that I want to have in my hands other than a loaded gun and food. I cannot think of any monetary asset that I would want in my hands other than silver if markets close. And I'm not dissing gold. Gold is for, that's your store of wealth, but you're not going to trade in gold. I mean, you're going to have a hard time with silver eagles or 1 ounce bars or 1 ounce rounds, silver rounds. You're going to have a problem getting change back. I mean, if you deal with a farmer, and let's say you want 2 dozen eggs, how are you can't get change back, but a silver dime will do it.
Yeah. So why is
I do want to talk about that.
Go ahead.
Let me just mention this because I've got a bunch of emails in the last 3 or 4 days. The wholesalers have really pulled their bids back on junk silver. I was going to say we can start with silver because that's where the financial system very well could end, is with silver. There's obviously huge tightness all over the world in silver. India has doubled the amount of ounces. Forget about dollars or rupees. They've doubled the amount of ounces they're importing. The bullion dealers in China have basically closed down and they're not selling silver. The one bullion dealer that is selling silver is selling it at $128 an ounce. Silver's gone into backwardation where the futures or where cash is higher than the futures. The lease rates have exploded. It's primed and set up for failure to deliver. And I can't stress enough how important it is for silver not to fail to deliver, because if it does, it'll immediately spill over to gold. And you get action in gold like we're seeing in silver, that's the end of the system. And I say the end of the system because confidence will entirely break. And the fractional reserve / fiat system runs 100% on confidence. And if you break confidence, it goes back to what my late partner Jim Sinclair used to say: what is the value of a contract that cannot perform? And the answer is zero. And he posited that you could see gold futures at $10 offered, no bids, and $50,000 bid and no offers. Meaning people will not accept contracts because they know they're not going to perform. They want the real deal in their hands.
Physical delivery mechanisms for silver are under pressure. Lease rates, the cost to borrow silver, have soared from single digits to above 30% in recent months, a signal of acute supply strain. Meanwhile, inventory data for deliverable metal in major exchanges show low availability despite large denominated storage figures. In markets like London and New York, traders report difficulties obtaining metal that meets deliverable standards. This creates a vulnerability. When a large number of contracts seek physical settlement and cannot find it, the mechanics of futures delivery can break, rippling into gold, credit, and beyond.
Things, obviously, because we live in a computer age, things happen so much faster, than they did 40, 50 years ago. And we should talk a little bit about the two spikes in silver that we had previously to $50. 1980 with the Hunt brothers, and then 2011. The Hunt brothers, that was if you want to say that was vapor at the end. I mean, there was a huge spike. It was basically an intraday spike, or within a week's period of time. There did not stay at $50 for any real length of time. And then again, the same thing happened in 2011. We had the spike up. It didn't go through 50. It fell back, and then they smashed it. And of course, they smashed it in 1988 also. This time, I know it's not good to say this time it's different, but it is different. It's already different. You can see it. We've been over $50 now for a week? Maybe a week and a half. But the thing is, we've gone through 50, and the buying if anything, has increased. And the risk here is that the chart goes parabolic, and the blood in the water that the sharks smell is that there's not enough supply, and that that they can break these markets. And when I say break the markets, you've got too many longs demanding delivery, and there's not enough supply. And we're going to find out that both gold and silver have been fractional reserve markets where they counted on only 1 or 2 or 3% of the longs standing for delivery. It's been a process. This has been taking place for 2 or 3 years now. If you look at both gold and silver on COMEX, the first notice day, and I'll just use a number of 100. Let's say there was 100 contracts standing for delivery. Prior to a couple of years ago, 3 years ago, what would happen is you have 100 contracts going into first notice day. And by the end of the month, it might be only half or 25%. In other words, the longs liquidated, took cash settlement, and walked away. But what's happening now is you get first notice day with that same 100 contracts. And by the end of the month, you might have 150, 200, 250 contracts standing for delivery. So no longer can you count on first notice day being a big number, and that's going to shrink from there. What's happening is buyers are set up, they're buying that month contract and saying, I want delivery. So they're piling up now. They're forming a line, if you will.
Wow.
It's a bank run into gold and silver, and that's what's going on with COMEX.
Silver's modern cycles include dramatic spikes. The early 1980 episode and the 2011 run both saw silver approach the $50 mark per ounce, only to retreat under pressure. In 2025, we've seen renewed testing of that threshold. Historically, these peaks occurred amid monumental macro shifts, inflation surges, system stress. This time, the context is different, but the underlying dynamics, scarcity, speculative pressure, system risk, echo the past. If silver breaks decisively above this symbolic barrier with physical demand dominating paper supply, we may see a dramatic structural shift in the precious metals landscape.
You're not seeing retail in North America buy. You've not seen them buy for the last 9 months to a year. What I've seen as a precious metals broker, I've taken more sale orders in the last 12 months than I had combined in the previous 15 years. And what that tells me, and I've asked people, why are you selling? And 95 plus percent of the time, people say, I need the money. I got to pay taxes. I got to do this. I got to do that. The money is running out on the streets in the United States, the real economy. Another thing you can look at the traffic flow in Las Vegas. I mean, that's down something like 18%. What that shows you, those are real-time numbers showing you that the real economy is having a hard time. It's slowing down. You look at the official government numbers, they're all bullshit. They're telling you the economy's growing, inflation's coming down, everything's great. That's not the case. Now, in the rest of the world, yeah, you're seeing lines all over the place. How is it that other than possibly the government telling them don't sell any silver, we want to portray a shortage, but I don't think that's the case. I think there's a real shortage. Actually, I know there's a real shortage. Just look at what's going on in London. They're scrambling to be able to make deliveries. And it's just so important that people understand that if silver fails to deliver within 72 hours, you're not going to see markets open. Markets across the globe will not be able to open, in my opinion, within 72 hours.
For decades, the futures and derivatives markets for silver and gold, particularly via CME Group's Chicago Mercantile Exchange, COMEX, and other venues, have allowed paper metal to dominate price formation. But when delivery cannot be met, a contract's value is zero, which is exactly the collapse of confidence that threatens the fractional reserve structure of modern finance. When silver longs insist on physical delivery and supply is insufficient, we may see cascading failures, delivery defaults, margin calls, credit stress. This is not hyperbole. It's a logical consequence of a market built on confidence. The collapse of that confidence would ripple far beyond bullion.
150%. But they canceled, and they canceled all those orders.
Mm-hmm.
I mean, I think there's still lawsuits going on about that. But basically, what they did was they pulled the plug on that market, and they said all the all the days trading didn't count; they weren't trades. And that the way they did that was they didn't have to pull their pants down and say, "Look, we can't deliver this." I think that's not really the right way to look at it. It shouldn't be concerning if you're sitting on silver and markets close. I can't think of another asset that I want to have in my hands other than a loaded gun and food. I cannot think of any monetary asset that I would want in my hands other than silver if markets close. And I'm not dissing gold. Gold is for, that's your store of wealth, but you're not going to trade in gold. I mean, you're going to have a hard time with silver eagles or 1 ounce bars or 1 ounce rounds, silver rounds. You're going to have a problem getting change back. I mean, if you deal with a farmer and let's say you want 2 dozen eggs, how are you can't get change back, but a silver dime will do it.
Yeah. So why
I do want to talk about that.
Go ahead.
Let me just mention this because I've got a bunch of emails in the last 3 or 4 days. The wholesalers have really pulled their bids back on junk silver.
The larger stage is the global credit-based fiat system, where debt, leverage, and derivatives dominate. A failure in silver delivery is not isolated. It may trigger losses in derivatives, defaults in credit markets, and breakdowns in asset financing. Real economy indicators already show strain, e.g. U.S. retail activity, regional travel metrics. When collateralized credit cannot be trusted, leverage unwinds. And when leverage unwinds, interest rates spike, assets seize, and the real economy contracts. Silver may be the first fault line, but the fracture lines run across the entire credit-based framework.
Junk silver now, if you're going to sell it, you're looking at $2.50 or $3 below spot. The only silver above spot in North America are silver eagles. I think they're about like $1 over spot. But people are concerned that, oh my gosh, I'm not going to be able to sell my silver. Well, understand that when all this silver that's been sold, all this junk silver, that's been melted down. And of course, they've not made any silver dimes or quarters since 1964. So there is no more supply, and the supply that has existed, any of that that's being sold, if you're selling it at $2 or $3 under spot, I guarantee you your wholesaler is sending that to a refinery and just picking up the 3, 4, 5% VIG and putting that in their pocket. Understand that can't go on forever. And also, there are refiners now saying they're not accepting any more silver because they've been inundated, and it's a physical process. It's not like pressing a computer key and boom, it's done. They actually have to refine it out. They've got to refine the 10% copper out if they want to get it to 99.99 pure.
Yeah.
So while right now it feels a little bit, maybe did I make a mistake buying junk silver? No. If you wait a month, 2 months, 3 months, and this is assuming the system continues and does not collapse, in the future, in my opinion, junk silver is going to end up holding the highest premium of any form of silver in North America because the supply is being wiped out whenever anybody sells it. It's being destroyed. It's being melted down.
In this environment, the question isn't just will silver go up, but will the system hold? For investors, physical metal, silver coins, bars, may offer protection when paper contracts falter. However, supply chain disruptions, minting, refining, and rising premiums complicate purchase and sale. For the system, a silver delivery failure could be the catalyst that turns latent risk into public crisis. Institutional risk managers, policymakers, and serious retail investors should monitor lease rates, inventory data, first notice day deliveries, and unexpected policy shifts. Because if silver fails to deliver, it may be the beginning, not the end, of something much larger.
Well, first off, that will bleed over to gold, and gold will also fail to deliver. Understand that gold and silver have been suppressed. The prices have been suppressed literally for 50 years, since 1976 when they started with futures and options on metals. Understand that gold has been suppressed because it is the direct competitor to fiat currencies, whether it's the dollar, the pound, the euro, the yen, whatever fiat currency, gold is the direct competitor. Now, if let's say 10 years ago, gold didn't stop, or 15 years ago, gold didn't stop at the $1,900, $2,000 level, and it blew through, and it got to 4,000 like we are now, and then it moved to 6, 7, 8,000, and started spiking. What that tells you is it's not gold going up; it's the fiat currency that's losing value. So that spills out, and it becomes a loss of confidence, and that would have and will prevent the U.S. from using a credit card with. Hold on. It would prevent or preclude the U.S. Treasury and other treasuries that borrow, but the U.S. in particular, that has had an unlimited amount to borrow on the credit card. And thus, we've got $37, $38 trillion. It would cause interest rates to go up. It would just gum up the entire system, which would then gum up the real economy. But it would be extremely difficult for finance to continue as finance has continued, because it's been a Ponzi scheme, of credit, and it would cast a dark shadow on credit. Meaning, am I going to get paid back? People will be wondering about the credit system, and that's a problem. And you and I have talked about this before. Everything runs on credit. The entire financial system runs on credit. The real economy, everything that you touch, everything that you do every day has, credit has touched it in one way or another for that to have been created or be able to work. So it's important to understand that silver being such a small market, it's been very easy to manipulate. And they had to manipulate silver harder than gold, because if silver ever got on hand, then gold goes. And if gold goes, then you have confidence breaking. And understand that you were talking about derivatives. It's a zero-sum game in the OTC derivatives market, where there's over $2 quadrillion worth of paper or contracts. The problem with that, because it's a zero-sum game, if you have a huge winner, that also means there's a huge loser. And was that loss big enough to put the loser out of business? And if the answer is yes, then the loser can't pay the winner, which means the winner then becomes a loser also.
Right.
And that will spread across markets everywhere. That'll spread across credit markets. It'll spread across stock markets, equity markets. Interest rates will explode. That'll destroy the ability to carry real estate on debt. It's a seizure or a meltdown of credit is what we're facing.